Welcome, everyone. Thank you for joining us this afternoon for Keeping It Simple with Simplify. Today, we have Bill White, who's currently a senior fellow at the C.D. Howe Institute in Toronto. Previously, he was the chairman of Economic and Development Review Committee at the OECD in Paris, which regularly evaluates the policies of both member and aspiring companies. He was also previously a member of the Issuing Committee, advising the German Chancellor on G20 issues. He's an accomplished author on topics related to monetary and financial stability, as well as international cooperation. We're grateful to have his insights today, Bill. And before I hand it off to my esteemed colleagues, Harley Bassman and Mike Green, please remember that this webinar is for educational and entertainment purposes only and should not be considered investment advice. Before we hand it over to Mike and Harley, we have a quick poll that we want to poll the audience with. Jimmy, can you bring up that poll? Perfect. We'll kind of let the participants answer the question and the poll questions that we have. And then, Mike, it's up to you and Harley to take it from there.
Fantastic. Well, I'm thrilled to have Bill join us. He sent a very kind note to Harley earlier this year, complimenting Harley on some work that he had done. Why he would do such a thing, I don't understand. But with that as quick background, Bill is known for his work both in central banking as well as on the theory that he's been working and promulgating, which is this change from an era of plenty to an era of shortages or scarcity. Global warming certainly contributes to that, requiring us to rethink supply chains in a very fundamental way that could potentially dwarf the challenges we're dealing with in terms of thinking about a relationship between the United States and China. And so we thought there was really no better way than to come out of 2023 or head into the fall of 2023 thinking about some of these issues. And it's interesting. We have our poll results here, Bill. I don't know if you can see them. It sounds like we're pretty well split, because there's almost a picture of the political environment in terms of the debates around global warming and the implications associated with it. Looks like we skew a little bit towards the conservative side of interpretation in our audience, which doesn't surprise me that much. Were you able to see that, Bill?
Yes, I did see it.
Yeah. Were you surprised by this reaction coming from a group of investors that climate change is more of a natural phenomenon with limited prospects for us to reverse it?
Well, my own personal view is that this is something that is totally man-made, and that it will be an enormous challenge to try to reverse it. I think it's possible, but the number of conditions that are required to do so are very onerous. I just recently wrote a paper which basically referred, as indeed did the ancient Greeks, to the should, could, and would problems of good public policy. So first of all, you have to have the analytics to know what you should do. And that is, there's many, many uncertainties when it comes to climate change. There's no question about that. Then you have the would problem, which is the question of, do you have the power to do what you should do? And of course, in the kind of world we currently live in, and you think about the geopolitical stuff, we may have the power, but it's not exactly distributed in places where we'd like it to be. And then lastly, you've got the would problem. And the would problem really has to do with knowing what you should do, having the power, but having the will to do it. And it's almost a philosophical Nietzschean kind of consideration. And of course, in Western countries, and I can't speak for elsewhere, we have a real problem in getting everybody on side about the need for action. And that includes ordinary citizens, it includes the powerful, and it includes the politicians. And in a sense, I'm not surprised to see the results of your survey, because I've seen other surveys, and what I find really disconcerting is that people's reaction to it depends on which party they belong to. Yeah. And so that you have an element here not of sort of factual objectivity to the degree that you can do that, but you have people basically voting their party beliefs. And beliefs, as we know from, what's the word, epistemology 101, knowledge is justified belief. And if it's going to be done just on the basis of my gut tells me, then, gentlemen, we have a problem. And I actually find that quite worrisome.
Yeah, no, so it's interesting. I agree with you. I think the disconcerting aspect is the tribalism component to it, right? And the seizing on tribal facts as compared to an attempt to deeply dive into the science of it. Unfortunately, actually, if you deeply dive into the science of it, there's a lot of debate about that as well. And I think part of the frustration I think that many people feel in both tribes is the perception that neither side actually wants to hear their series of facts, or if they do not accept them, that it is actually purely a byproduct of tribalism. My personal belief is that it's, as we were discussing before, it's a function of X and Y, right? Certainly humans have contributed to it. It would be surprising to think that we would create the amount of energy from a latent energy source that had been sealed in the bowels of the earth in the form of fossil fuel, that we would release that and that would not have a contributing impact in one form or another. On the other side of the equation, the process of human development over the past 10,000 years is largely the byproduct of us coming out of an ice age. So it's hard to imagine that there isn't a natural component associated with the global warming that is contributing. And I do think the real question actually boils down to how do we choose to interact with individuals who decide that they want to participate or who decide that they don't want to participate. And this is, like, as a society, we feel very fractured. And unfortunately, I think it goes in both, we've seen examples of this, right? With COVID pandemics, do you mask, do you not mask? Do you get an injection? Do you not get an injection? These have turned into extraordinary debates that I would describe as largely very much like the Dr. Seuss, Sneetches with stars, Sneetches without, or, do you eat your bread with the butter side up or butter side down, right? We'll fight over just about anything out there. You have actually taken some of this work that you've done in climate change, and you've talked about the challenges that it creates. And this is kind of one of these, I would argue that this is one of these debates that investors need to kind of resolve, whether they're thinking from a tribal standpoint or otherwise. Are we looking at an environment in which there's much greater shortages, or are we looking at an area in an environment in which there have been temporary shortages caused by some extraordinary events that are likely to manifest themselves actually in what I would describe as broad surplus emerging? I tend to actually take the exact opposite view of you on this, but I'm very open to kind of, what is your base case? How are you thinking about this? And then, let's maybe go back and forth a little bit on this. And I'm sure Harley will have something interesting to say in this process as well. I have a lot of respect for his thoughts here. So with that said, Bill, why don't we launch into a few slides that you had shared as part of a presentation, and I'm going to pull these up here quickly. Give me 1 second. Okay. All right. You should see Moving from an Era of Plenty to an Era of Shortages, presentation by William White, otherwise known as Bill. You guys have that on your screen?
Yep.
All right, fantastic. So, Bill, you gave this overview, a world moving from plenty to shortages. Why don't you take over for a second and tell us, what you're thinking about here, what the context was, and I can advance to the next slide if you'd like.
Okay, well, let me just sort of run through these bullet points fairly quickly. Yep. My basic thesis is that really starting, and this is rather arbitrary, but really starting from the fall of the wall, that we moved into an age of what I call plenty. It has continued up until quite recently. I think we have turned a corner, and that we are going to be looking forward to an era of shortages, because basically everyone, and I can run you through this, every one of the factors, the supply side factors that were positive over the course of the last 30 or 40 years, are now turning negative, all of them. So it's not just climate. It's, which used to be benign and now no longer will be, I think. So there's a wide number of these things. And that's why I say it's really a whole age that is changing. The problem, and I don't know how much you want to get into this, but during that age of plenty where we had these positive supply side shocks, the Fed in particular, but I think the central banks more generally, totally underestimated the impact of those positive supply side shocks. And so we had a few decades really of the prices wanting to go down. And the Fed basically and these other central banks wedded to the idea of price stability, positive inflation, 2% come what may, basically pulled out all the stops in order to ensure that those negative prices didn't in fact emerge. I think it was initially wrong for them to have done that. Story gets a bit more complicated the longer it goes on, but I think it was wrong to go down that path. And the upshot is that because monetary policy was so easy for such a long period of time, and certainly including the period of the great financial crisis, that it induced a lot of extremely bad behavior on the part of financial market participants such as yourselves, reaching for yield and doing a lot of things that, in retrospect, we now see were not really profit enhancing. That now constrains future policy, and we talk about it really on a daily basis, with the Fed sort of now starting to tighten in face of the inflationary pressures that have occurred recently, and starting to worry about the impact that both the level and the change are going to have on people whose position is extended in a certain way. And the worry that there might be some kind of, significant financial crisis that would lead to a downturn. And then I go on in this slide to talk about what the alternatives are, given where we are. And this last bullet point makes a point that I've been making a lot in various fora, and that is that I am of the view that you cannot think about the economic and financial system as a standalone system, that human progress depends on a number of systems working properly. So the financial and economic situation system has to work properly. The political system has to work properly. The public health system has to work properly. And as you and I will be discussing, the environmental stroke climate system has to work properly. And my real worry, and there's a lot of other people out there are worried about it as well, is that each one of those systems is now highly stressed. And problems in any one of those systems could lead to a kind of tipping point, which then cascades into the other systems. And in the end, what you wind up with is a kind of what they call a polycrisis, where we have problems in each one of these systems interacting in ways that are almost impossible to control. So this is just another way of saying that the stakes today, whether it's climate change or whatever, the stakes at risk of policy mistakes are extremely high. I don't pretend to have an answer to these problems, but I do think it is important to understand that we're playing with some very important stakes. Important stakes at the moment.
Bill, let me go and jump in a second. Just to go and dial back, my view is that this climate change is, I guess, human accelerated, but I don't think the problem is, dinosaur guts per se. I think it's 7 billion people, and managing, surviving, feeding, transporting 7 billion people is the problem. Unless we're willing to go drop nuclear bombs on China and India, I don't see how we're going to solve this thing with the technology we have right now. Can there be new technologies? Yeah, I suppose so, but I think it's 7 billion people is the issue, not the overusage of fossil fuels and private jets, which leads to the second point here about plenty versus shortage. Now I'm going to summarize Mike's view that he believes in plenty from production of things. I agree with you of plenty of shortage, but I think that's just a fancy word for demographics. That the time you're pinning 89 is right when the boomers were becoming very productive, and they were forming households, and they were buying houses, buying baby carriages and cars, and you can basically track the labor force growth rate versus interest rates, and they go pretty nicely. And now we're rolling over, and you're actually seeing the boomers retire at a substantially faster pace than we expected from their demographic profile, because the Fed pumped up asset prices. There was inflation. Sorry, Mike. There was plenty of inflation. It was in assets, not wages initially. And the boomers have taken these. They're the owners of the assets, right? They're the locusts that went over the land and took everything from the millennials. And they're now retiring early because they have all these assets. And so I think plenty of shortages is basically demographics, and which is going to play out everywhere in the Western world, except for, I guess, Africa. Do you have a comment on that, Bill?
No, absolutely. And my first boss at the Bank of England when I started working was a guy called Charles Goodhart. And Charles and his colleague Pradhan published a book here about a year or two ago, which has been very widely and favorably reviewed, which is called The Great Demographic Reversal. And they got a whole book on this stuff. And basically it conforms to what you've just said, Harley, which is that we went through a long period of time where we had lots of workers, and healthy, educated workers to boot. And that was not just a phenomenon in the advanced market economies, it was a phenomenon in the emerging markets as well. So we had China with a rising population, Japan less so, but there was lots of workers, particularly new workers after the wall came down, who had previously been in command and control economies, but who were now added to the global workforce and the market forces. Okay, and that was a very important factor, pushing down wages and pushing down prices. And now, when you talk about the demographics, and that's not the only thing that I told you that I'm concerned about that's going to turn around in terms of sign, but when you look at the demographics, you can already see, and it's not just the rising retirement rate in the United States, you see everywhere that the number of workers, the baby boomers they're gone through, they're at retirement age or over. And it's not just them in the advanced countries. The emerging markets now, the labor force has been declining in Korea for years, declining in Japan for years. It has begun to decline in China. So there are some, I think my friend Charles is absolutely right that there is going to be a great demographic reversal. The thing so you've got all of these people that used to be workers and supplying things. They added to aggregate supply. I don't think there's any doubt that that's going into reverse. A question which seems to be more contentious, and I have my own views on this, seems to be more contentious, is do older people consume less? So you made mention, of guys with young children buying baby carriages and houses, and they don't have to do that anymore. But the older people now that are not working are going to be consuming not just leisure product, which they're certainly doing, right? If you look at the latest numbers for travel and blah, 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 but in addition, they're going to be a huge consumer of healthcare, okay? And that is an area where up until now, productivity increases have been very hard to provide. And more people coming up with Alzheimer's, which means that there's going to be more and more people in principle involved in the kind of hands-on care where productivity increases are almost impossible to apply. So I think the demographic reversal is going to be a big factor, implying that there will be a shortage of, relative to the past, there will be a secular shortage of supply relative to demand. And I guess my sense of that is that this is along with all the other things that I'll mention if you want me to, is an absolute recipe for higher interest rates, higher inflation and higher interest rates. Well, that's the environment I think the investment community should be prepared for.
I think you're hitting on, Mike's, early Alzheimer's right now that he's forgotten. He kept saying to buy bonds over the last 2 years, ignoring that small detail. Let's go back to this demographic issue. The reason why the U.S. has done so well versus everybody else, I mean, our stock market is over doubled versus relative to Europe, is that we have, sorry, trolls, we have immigration. we have people coming in who will work and be productive. Do they pay income taxes? Maybe not, but when they rent a house, that the landlord pays a property tax. When they buy goods, they pay sales tax. So we've had positive immigration up until 2016, which we've now kind of clipped, which is a huge cost. But let's just look at the issue of demographics. If demographics is really the core of the whole idea, then your notion that Fed policy has been good or bad, isn't that just deck chairs on the Titanic? Does it really matter? If we have this massive shift in demographics, there is no fix, is there? There's no Benjamin Button scenario where we can go backwards in time and birth new people. I mean, we know what the population demographics is going to be for the next 40 years pretty easily.
Well, we think we do, but I think if you go back in history, you'll find that even the demographers have made some pretty big mistakes. But I think that the point that I want to make, Harley, is that there are sort of elements of sort of moving the chairs on the Titanic, and it's in terms of monetary policy, and it's not just. And I want to make this point. The change in the sign of the supply shock from positive to negative is not just demographics. There's a whole other list of things that you can talk about. I mean, one of them is the whole question of the political order and the benefits of globalization. I think that's on the next slide that I think I was talking to. Can you put that up, Michael? Somebody?
Sure.
That's the next slide. Yeah. So there's a whole list there that I think people should focus on of things that really were very positive for both real growth. I'm talking supply side now, real growth, and for keeping inflation down. So the benefits of globalization, I don't think I need to talk very much about that. We all know what happened, the increase, massive increases in trade and specialization and all that stuff. And then we had the demographics. I think that the business about the focus on efficiency and shareholder profits, that period from 1990 on, Reagan, Thatcher, supply side economics, it was real. I mean, stuff happened. People were really focusing down on increasing efficiency and on shareholder profits. And I think that had a big impact in terms of bringing in stuff that was, more of it and cheaper, et cetera, et cetera. The plentiful energy and other resources, we had massive increases in population, massive increases in food requirements, massive increases in energy requirements. I can't remember the exact numbers, but I think from the time of about 1990, coal and gas went up something like 70%. Our consumption of coal went up about 100%. And all of this stuff just happened sort of easily. There were no major problems. So big increases in demand, plentiful elasticity of supply. Then you get this question about digitalization, the beginning of the internet age and all that kind of stuff. And I mean, when you think about everything that's happened in the last 20 or 30 years, right? It has been absolute fantastic increase in our capacities to do things with new technology. And then we talk a lot about about supply, but this last bullet, I think, makes an important if incomplete point. And that is that over the last 20 or 30 years, investment levels have actually been lower than they were in previous decades. And it raises a very interesting question about why. Charles Goodhart is of the view, and I think he's right, that if you had this big increase in the working age population, it translated into lower wages. Okay? And so if you have the lower costs of a certain factor input to production, labor was cheap, so you relied on more labor and less capital. And that was just sort of the way that the whole thing worked. The other thing, which is not mentioned on this slide, is that when you think about government spending, both guns and butter, okay, the last 20, 30 years, we haven't had to worry about that kind of stuff too much, or at least we didn't worry about it. I think we should have, but we didn't. So there was a massive increase in spending for defense. And in most countries, there was a pullback from sort of the redistribution of income through governments, because it was that, what's the word? It was the era where you said what's the word? The markets will sort this whole thing out. So you had this long period of time, it seems to me, where you had negative supply side shocks, positive supply side shocks, and essentially negative demand side shocks, all of this relative to the previous 30 or 40 years or whatever. And the upshot of it was increasing disinflationary forces and interest rates that were a lot lower than they might otherwise have been through the actions of central banks. And as I said right at the beginning of my comments, I think that whole era of easy money has left a residue of problems, not only having to do with financial instability, but potential fiscal unsustainability, that I think are going to haunt us for a long period of time. Now, all of that stuff gone into reverse.
Mike, rare is the time you will invite a guest onto this show who will take my side of the story. I know you like doing a two-on-one with me, but for once, like, you're on the one side. How do you respond to all this? You're on mute.
You're on mute, Mike.
I have to unmute myself. So both you and Bill really walked into my trap, and I just want to say thank you for doing that. So first, Bill, I'm very familiar with the work of Charles Goodhart. He actually pulled his data. If you look at his book and his paper that was written back in 2017, all of his work was actually cribbed from the work of Eunice Aksoy, right? So Eunice Aksoy actually did the study of demographics, and what he attempted to do was to build a panel across different countries to identify the impact of changing demographics and age structure. One of the things that he actually did in order to do that was, by moving across multiple countries, he had to introduce controlling variables. The variable that he introduced to control was population growth. And so it actually turns out has by far the highest coefficient in terms of inflationary pressures is population growth. The supply of workers, by definition, is actually an increase in the number of people who are demanding more than they currently have. Otherwise, they'd simply stay on their sofa. Right? They're actually saying, I want to increase my consumption by participating in the labor force, particularly at younger ages. That becomes remarkably inflationary. And I actually just want to show you the panel data from Aksoy on two separate components. So I'm going to go outside of my presentation. This is from the work of Eunice Aksoy, which, if you read Goodhart's paper, he'll tell you he literally just lifted this uncritically.
My understanding was the first thing that I saw having to do with Goodhart's work on this was when he was an advisor, I think, to Morgan Stanley.
Correct.
Is that where this work was done that you refer to?
No. So the 2015 paper by Eunice Aksoy actually preceded that, and then in 2017 is when Charles Goodhart wrote his thesis around future inflationary pressures. And so if you actually read that, you'll see that he directly goes into that. So there's a couple of things that are actually worth highlighting. This is the coefficients associated with the aging across multiple generations. You can actually see this hopefully on the screen. Here's the inflation coefficient. This is the inflationary pressure that he's talking about, moving from the minus 0.81 associated with middle age to plus 0.08 associated with the older population. That's actually not the more important change. The more important change is the younger generation, children. They are by far the most inflationary pressure that you can experience. And it's a function of growing households, et cetera. I want to push a little bit further. They go a step further. They further segment into 8 separate generations. And if you notice, the coefficients turn negative again for the very, very old, which is actually where the growth in population is by and large occurring across the Western sphere.
So your general point, Michael, let me be clear about this. Your general point is that as the population gets older, the demand will actually go down relative to what it was in the past.
Right. So there's 2 separate types of consumption that are occurring. One is and you obviously know this, one's what's called an imputed consumption, right? Which is, I live in a house that was built 100 years ago. My husband has now died, and therefore I'm consuming twice as much house, even though I don't actually spend any more money, right? If anything, I'm actually spending significantly less as I've shrunk my household, but that actually shows up as an increase in per capita consumption, which often gets confused in the inflationary literature as higher consumption amongst those who are in the older generation. I also am not going to dispute at all your comment about healthcare, but would point out that the same statement, and I actually wrote a Substack on this, I'd love your thoughts on it, I'll share it with you afterwards. If we had looked at the world in 1925, we would have confronted the unbelievable expense and growing expense associated with tuberculosis, which had exploded with urbanization. We'd gone in the United States from somewhere in the neighborhood of 600 sanatoriums to 600,000 sanatoriums between 1900 and 1925. If we had used the same techniques that the CBO uses for projecting forward medical care costs in 1925, today we'd be spending 50% of our GDP on tuberculosis treatments. They currently cost about $5 billion a year globally. So we spend nothing on tuberculosis, which was extraordinarily labor intensive, extraordinarily cost intensive, extraordinarily debilitating. Today we spend nothing on it. And I would actually highlight that the highest cost that we face within our healthcare system is tied to obesity. And crazily enough, the latest round of the GPL inhibitors, they're actually showing up as a cure for diabetes. They're eliminating the need to apply insulin, for example, in the
Michael,
latest tests.
if you're making the point that technology might get us out of this stuff and out of all of these problems, whether they be health or climate or whatever, I have no dispute with the possibility that that might happen. And indeed, you can tell, you can, what's the word, weave a narrative about some of the way in which various technologies are coming together to lead to a much brighter future. It is possible. But I think I, again, sort of go back and agree with Charles when he starts talking about productivity increases, that there's so much dispute within the economics within the economics profession, the people that are supposed to know about this stuff, it's really very hard to, as it were, assume that this stuff will happen. It might or it might not. And we're certainly going to have to be conscious of the possibility. I guess the point that I'm trying to make here about these sort of supply side things, whether you're right or whether I'm right, is that there needs to be a lot more attention to supply side changes than has recently been the case. I think the Fed and the central banks and the others have for decades basically relied on things like Kalman filters and have totally missed the changes that were taking place right before their eyes. So we definitely need more care in interpreting these prospective developments.
So I actually broadly agree with that sentiment, but I would highlight that when we talk about Goodhart's work, or that it's very well received, we are increasingly programmed, and I would actually say that this is partially a function of the aging of society, right? We're increasingly programmed to believe that the worst is ahead, and that we have benefited in some unusual and exigent way from things that have never happened before and will never happen again. I'm not suggesting that we should ignore these, but when we turn around and we say that the aging population is inflationary and ignore the actual underlying data that says, no, the single biggest variable is actually population growth, and that has turned negative, that suggests a completely wrong interpretation under our current policy making, that we're worried about fighting.
I'm not familiar with this work. And all I can say, Michael, as indeed I did say before, is that the question of what will happen to demand as a result of the changing demographics does seem to be in significant degree of dispute. And I would be perfectly prepared to look at it.
That's going to be the interesting one.
I'll toss it over here that once again, Mike, if you're going to believe me or your lying eyes, I mean, Social Security, age 64 or 65, 1936 is like age 83 now. And the amount of wealth in this older demographic is monstrously huge, and they're going to spend it. So, I mean, looking back at these old numbers from the 50s don't impress me all too much. All I got to do is look what's going on there. You have the geezers, the boomers are up and going everywhere. And also, people go to work because they want food. If that was the case, then you're forgetting that mom kicks the kid out of the basement at some point. If he just wanted food with no work, he'd stay there. I mean, I think we have to have some common sense here as opposed to just tossing out tables of numbers.
Well, wait a second here, because we actually, Harley, we're actually seeing exactly that. The proportion of children that are living at home with their parents has hit levels that we've never seen before.
And they're spending it too. Bill, let me go switch topics over here. You've been talking about, we kind of got in contact with a paper I wrote about moral hazard, where I kind of said, I think that measured pace in 04 and 06 was a major contributor to the great financial crisis, because if you're told that rates will go up by 25 cents every 6 weeks, you're going to go sell a lot of options because you know what's going to happen. And the dots and forecasting, once again, you got people very comfortable. I think the big banks that all went down basically took Powell as word when he said with the dots, we're going to be at 0% rates until first quarter of 2023. And he kind of almost promised that, and we ended up in the pooper. What do you think about that concept of Fed policy? And I got one more thing. Do you think that the government was right in letting Lehman go down?
Well, I think in terms of all the unconventional policies that were followed, when they tried to get to reverse the disinflationary forces, and they went from zero interest rates to, in some cases, negative interest rates, as you know, in Europe. Then you had forward, so that was the short end of the yield curve. Then you had sort of forward guidance for the medium part of the yield curve, and then you had QE for the long end of the yield curve, trying to get the rates down all the way through. I guess in retrospect, my sense is that it's all proved to be a bit of a cropper. That the negative rates. I mean, less said about negative rates, the negative rates, the better. But in terms of forward guidance, I think now it has been realized that you really do set yourself up for inducing people to behave in ways that then subsequently prove to have been wrong, and ultimately lose your credibility and lose the trust of the people that are supposed to be trusting you to conduct good policy. And the QE thing, I think that strikes me sort of most recently, is that when you think about what QE is basically an asset swap, right? So if you take a consolidated balance sheet from the government and the Fed, basically what you're doing is you're buying in long bonds and you're replacing them with the shortest securities of the shortest possible maturity, which is overnight money at the Fed. And I think the last number that I saw, it's a footnote in the Fed's books in March. I think their market value losses now are something of the order between 900 billion and $1 trillion. And one might say, well, so central bank doesn't need capital. I think their capital is about 50 billion, so they're well underwater. And you might well say, well, we don't need positive capital because we always have the benefit of positive seigniorage going forward. Once this temporary problem is over. But I do worry about the optics of it. And people that are worried, for example, about the overall size of the government deficit and the stock of government debt, the ratio to GDP, which in the U.S., I mean, all of these numbers are going off the wall. And people sort of worry about it and what might be the implications. Well, when you just take the simple observation that the increase in the government deficit, and this is not just the stock of government debt, I should say, and it's not just a U.S. phenomenon, it's much broader. The increase in the stock of the debt is basically the same as the increase in the size of the Fed's balance sheet. The optics of it just look pretty terrible. And I do worry going forward that, this could start to have an impact on people's inflationary expectations. Now, again, wait and see. But I don't like the optics of the way this thing has worked out. So I'm not really a great fan of what has been done. I think that the longer term costs of those policies have been greater than the shorter term benefits. And I think there's a lot of people doing a lot of thinking about the merits of what has been done. On the Lehman Brothers thing, I guess my sense of it, a lot of people want to talk just about the event, right? The failure of Lehman Brothers. And it needn't have happened. Okay. There's all this talk about what Paulson, his interpretation of the law and how much politics was involved. But the basic message was it happened. It took down all those other firms with it. It led to the great financial contraction, both in the States and elsewhere. And it was a terrible mistake. And my reaction to the whole thing is totally different. I think the whole history, I mean, this goes back to Alexander Hamilton. The whole history really has been extension of the safety net. Every time something starts to look dangerous, the Fed comes in, the government comes in and extends the safety net. And Lehman was actually a kind of exception to the general rule. And you think about what happened with SVB, right? The sort of implicit guarantee of all deposits and no haircuts on the collateral that the Fed is taking. So we've got a long history here of the safety net just getting bigger and bigger. And my worry about that is, one, it creates enormous amounts of moral hazard. Two, I think it's politically reckless. I mean, I don't know in how many countries where the political reaction to bailing out the bankers has been extraordinarily negative against a backdrop of widening inequality, of which we haven't spoken thus far. Okay, so this sort of stuff has big political implications as well. And lastly, I worry about contingent liabilities to the state as being a contingent increase in the deficit in the stock of debt at a time when it's already looking like it's getting pretty close to being out of control to begin with. So all of this safety net stuff really worries me, to the point where I guess I've been writing stuff that, while not giving explicit support to the suggestion we should move to an entirely different narrow money regime, I'm certainly prepared to say that the faults of the current system, the way we operate it, monetary policy, regulatory policy, and safety net policy, that the way we operate it, its faults are so great that it is worth thinking about alternatives. And we should be doing that far more than we are, because every time we have a problem, all we've done is we've done more of the same and still more of the same in reaction to it. And I think it's digging the hole deeper and deeper.
I agree, Mike.
So there's aspects of this that I think I'm going to agree with, right? I agree that the dynamics of moral hazard and the continual.
Well, I guess that's the end of this program then.
No, we don't have to stop there, because so the point that I would actually emphasize is I think that there's actually, I mean, again, this is one of these interesting things where it's X and Y, right? Should we actually bail out banks? Well, it depends, right? I mean, in an interest, I agree with you, by the way, the idea that we stepped in and bailed out all the depositors of Silicon Valley Bank or First Republic Bank, which, by the way, I was one, is somewhat absurd, right? There wasn't really any structural value that was created there other than suspending a run on banks, which could just as easily been accomplished by saying, well, we'll extend it to everybody else going forward, right? You happen to be the bad losers. And by the way, there's very clear evidence that the behavior of depositors contributed to the losses at Silicon Valley Bank, right? So we actually have bailed out effectively the bandits that stepped in to take the money out in the first place.
Yeah.
The question that I have on this is, when you talk about safety nets, who is it more important to extend the safety net to? Is it more important to extend the safety net to corporate entities, which have theoretically unlimited lives, caretaker governments, in the form of executive management teams that aren't necessarily significant owners? Or do we bail out households who have been caught in the crossfire of events that are understandably far outside of their control? And I think most of us would actually turn around and say, certainly I would place the emphasis on human capital. And over the past 40 years, we've done the exact opposite. We've placed the emphasis on capital over human capital.
Yeah.
So Bill,
I totally agree with that. I think and that's, as I mentioned before, I think that's one of the reasons why the ordinary people that have felt they've been sort of ignored in this kind of restructuring stroke safety net balance, they feel that they've been ignored and they're angry. And I think that
I would argue they have a right to be. I mean, again, this goes back to the question of, are we in an era of scarcity or abundance? And I think the answer, unfortunately, is both, right? Capital owners are in a period of absolute abundance. We have more homes, more children than we've had before. We experience luxuries in our life that most people can only fantasize about. And yet, exactly as you're highlighting, places like Korea or in the United States, where we're seeing a collapse in fertility, that's behavior we see in the animal kingdom when you're encountering scarcity. That began a long time ago, right? We've been seeing dramatically falling fertility rates for an extended period of time. That suggests stress and shortages in this time period that's actually much more consistent with kind of the way I would approach the world.
I think, Michael, that you're back. I'm going to agree with you again that it's both X and Y. So It's been an era. I said this actually in my written stuff. I should have said it here. That the age of plenty was not an age of plenty for everyone.
Right.
And if you have a big component of the age of plenty coming from globalization, and the workers in Asia are getting more by pushing down the price of wages in the industrial countries, I think they did contribute in a material way to the opening up of this gap between the return on wages, the return on labor, and the return on capital. So for the vast majority of people in sort of, let's say, the United States, you're probably right. It was not an age of plenty. It was a global age of plenty because billions of people were lifted out of poverty. Okay. But there was one sort of element that didn't share in that bonus. And that, I think, was the workers in the industrial countries. And that's
I think that's I mean, I think it's a reasonable combination. I did want to show you one other slide, and I know that you've it does feel like we are actually very much aligned in interpretation of some of this, although I think the differences that I would have in the emphasis on the demand side of the equation as compared to the supply side of the equation, that feels somewhat difficult for us to reconcile. My fear, by the way, is that all of the concerns that you and I just both agreed on, right, that there has been an emphasis on capital as compared to labor, we're now actually seeing manifest itself in the behavior. If you listen to the language, the problem, Harley said it explicitly, the problem is 7 billion people. I look at 7 billion people and say, wow, that's an amazing solution. Can I have another billion of them, please? And on the flip side, I was saying, the problem is workers are demanding too much at a time of record corporate profits, right? I mean, these are all things that feel very inconsistent with the narrative that we need to start to change that behavior. I did want to show you a couple of charts. So this first one is actually tied to your language of a recipe for higher inflation and tight money. This is looking at rolling 10-year inflation cycles in the United States. And I think this is actually a really interesting question, because I would argue that we're basically at a Scylla or Charybdis, right? I mean, we've come through the really unusual period of remarkably stable inflation. And in either direction, deflation or inflation, this turns into a losing game. And that more than anything else is kind of what's keeping me very focused on these questions. Because if I'm correct that the real issue is a loss of aggregate demand, and I would point to falling populations, declining population growth, et cetera, the loss of children, aging populations is all reinforcing that. And we've chosen to adopt policies that further restrict supply and demand. In other words, cut aggregate demand even further. then we could have very well plunged ourselves into a very adverse outcome.
Well, let me put it this way. I think we have very different views, really, about the overall impact of supply side changes going forward. I think they will be more inflationary and will lead to higher real interest rates. Having said that, I am really torn between, does that mean a significantly inflationary future for a long time, or rather, do the higher real interest rates associated with the inflation against the backdrop of the debt overhang, both public and private, lead to, well, let's say private, okay, the overhang of private sector debt, lead to something like significant financial crisis, recession, depression, something of the order of Irving Fisher, 1932 debt deflation. I can tell a story about that happening. I can also tell a story.
By the way, that's the one that I jumped to. But yes, go ahead.
Yeah. But you can also tell a story, which is essentially the Latin American story, which is that the more the private sector has a problem, and go back to safety nets again, the more the private sector has a problem, the more the government tries to step in and sort it out. But it doesn't have the resources to do it. And in the end, what it winds up doing is what it's already begun doing, which is relying on the central bank for a source of financing, increasingly. And eventually, as happened in Latin America, people cotton on to what's going on and they say, I'm out of here. And then it's capital flight, and it's the kind of problems that Latin America has had forever. And it is not impossible. We tend, there is this implicit kind of, I don't know what you want to call it, racism, tribalism, whatever, but we're too smart in the advanced countries. It couldn't possibly happen here, but it could happen here. It happened in Central Europe in the 1930s. It happened at the end of both the First and Second World Wars. So anyway, I have my view of the supply side, but even having had that view, I see it is not so easy to forecast what the future will bring longer term in terms of these deflationary forces as opposed to inflationary forces.
Bill, following up on that.
Hallelujah. We're very much aligned on that, Bill. Harley, give me 1 second. Just to emphasize, Bill, I don't know the answer. These question marks are genuine. I don't know which one we have. I would highlight, though, that the aggressiveness with which central banks have moved to tackle what may or may not prove to be a transitory inflation has actually raised the risks of the deflationary bust that then leads to the outcome you just described.
Yeah.
Right. That actually strikes me.
You may be aware there was a quote in Paul Volcker's book. I don't have it exactly at hand here, but where he talks about the way in which they were sort of leaning against a deflation and creating the easy money and the debt. And he concludes in his autobiography that by trying to get a little inflation to avoid the deflation, they may have wound up producing the deflation that they didn't want to have. And so I think Paul Volcker was talking about the same kind of process.
Yeah. Paul Volcker or Paul Krugman, I'm sorry.
Paul Volcker.
Paul Volcker.
In his autobiography.
Yeah.
Bill, so
I'm not familiar with that quote, but possible.
Yeah, we claim to be an
Harley,
entertainment show, but once in a while we do investments here. I can, give you quick answers. What do you think about gold? What do you think about tips where you can buy a real rate of about 2% for 30 years? And what do you think, when will the yield curve flatten out? I mean, uninvert. So gold, tips at 2%, yield curve movement.
Well, I think gold, certainly we're not going to go back and put gold at the center of the international monetary system. That's just not going to happen. So gold tips 2% real for 30 years. If you buy my story, okay, the potential growth may be 1% for the next 20 years. 2% real would be pretty good. And the third, remind me again, sorry,
The
Harley.
yield curve is very inverted right now. Yield curves
Yeah.
rarely stay inverted for very long for one reason or another. When might this yield curve uninvert and how might it happen? It sounds like you're saying the back end goes up more than Mike saying the front end goes down, but I'll let you answer the question.
Yeah, well, I think there's a reasonable chance that the back end will go up. But again, it goes back to my belief, I guess, or suggestion that the future is likely to be more inflationary than most people currently believe. And so the short end will have to go up. And I guess in accordance with the sort of convention, that the nominal rate is equal to the real rate plus the nominal. That if you believe that the long rates will go up as well. And then there are all these ancillary things that they're all sort of blended in together. At what point do the market say the sovereign is not really riskless in real terms? That the government bonds are actually could well go up more. Government deficits can't be financed, blah, 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 all that range of territory. As you said earlier, I think, Harley, the credit spreads are still sort of, not sort of in any way sort of extended. At a certain point, people may begin to realize that future is going to be rockier in the future than it has been in the past. A lot of companies that, look okay at the moment in that different environment will not look okay. A lot of the unicorns will be seen for what they are. Yeah, I don't have a problem telling a plausible story about interest rates going higher. As for the timing, well, when I was the head of the research department at the Bank of Canada, and we were in charge of the forecast, and the motto was always, give them a time or give them a number, but never give them time and a number.
Yeah.
Mike, do you want to go and
that's
mark
my
to market?
defense on the buy bonds story, by the way.
Mike, why don't you go and mark to market the team trans view?
Well, I would actually argue that the team trans view has been proven correct if I actually look at month-over-month inflationary numbers. Using the Fed's core services X housing number, we're well below 1.5% at this point.
I'll talk about making money, though, with rates. I mean...
No, so that's actually, Harley, this is, again, I understand your glee at this, right? But this is actually a really important question. Why, exactly as William described, we've gone from 30-year tips yielding negative 0.65% to 30-year tips yielding positive 2.1%. That is a generational change that's happened in 18 months and has had no discernible impact on risk markets.
Well, the Fed went and bought a quarter of all the tips. For
that time period, they actually have been selling tips. Why has that not affected the yield of tips? What that should affect is not the real rate, which should have gone down under that model. You should have actually seen inflationary pressures and compensation rise, which you haven't seen.
Yeah.
So I mean,
well, it's this broader.
Yeah, go ahead.
It's a broader conundrum, isn't it, Michael? I mean, why is the stock market still so relatively strong? And
so I actually think that I have answers for that, unfortunately, which puts me in a very dangerous place, right? The quick answer is I actually think the growth of passive investing has played a much larger role in the inflation of financial assets than has the behavior of the Fed. I think it's contributed. It's an X and Y phenomenon, but I think that the change in structure and investment has actually been really important. And unfortunately, I think the challenge is that because most people blame monetary policy, we're now actually engaged in monetary policy that is exactly as you said with Paul Volcker. We're likely to create the deflationary pulse that causes the societal fracture that then manifests itself in ridiculous populist behavior. And so that's actually part of why I'm pushing so hard on this, is saying, like, look, guys, we are playing a very, very dangerous game at this point, in which things like the Goodhart study, which people have not spent the time to look at the back literature. Goodhart chose to promote a particular point of view that fit with the objectives of his employer. Whether that was his intention or not, I'm not going to judge. But the simple reality is that, I can show you the underlying documents that say the exact opposite of his interpretation of the data. So we're in a really challenging time period in which I think the risk of us making an extraordinary mistake that generations after us will hold us accountable to is very, very high.
I just say I totally agree with that. I would repeat again, however, that the transition from an age of plenty to an age of scarcity reflects a large number of variables changing sign, in my view. And you may or may not be right about the demographics, but I don't think it's enough to convince me to change my worldview.
It's fine. I understand that.
Well, Bill, Harley, and Mike, thanks for the lively discussion. It was great to see you guys interweave, demographics, interest rates, economics, and investing together. For everybody on the webinar today, please don't forget to sign up for our next one, which is scheduled for October 12th. We'll have Doomberg on. So if anybody follows Doomberg's Substack or Twitter handle, please make sure to definitely sign up for that webinar. Additionally, if you want more information on Simplify Funds or what we're doing at Simplify, please check out www.simplify.us. And with that, we'll leave it, and I wish everybody a great evening. Thank you.